the Fed has raised rates too fast and lowered them too slowly. And even now, as the United States is by far the strongest economic power in the world, it's not even close. It was going to be close, but a lot of good things happened to us and some not so good things happened to certain other places. They're forced to compete, and we compete with nations that are getting negative rates, something very new, meaning they get paid to borrow money, something that I could get used to very quickly.
Let's introduce today's panel to get their reaction on all of this. Still here this hour is Akiko Fujita. Also joining us is Jim Awad, Clearstead Advisors Senior Managing Director. And to help us understand, to dig into what we can expect from the Federal Reserve's policy this year, John Augustine, Huntington Private Bank CIO. And John, clearly, the president's still at odds with Fed policy. You point out that all of us should get ready that 2% yield on the 10-year is the new 3. What does that really mean going forward?
Well, what that means is rates stay lower longer in our view, at our shop. And arguably what it means is the Fed's back on hold. They're going to keep short-term rates around 1.5%. And now the onus is probably on the ECB to see if they start to bring them up as we go through the year. They have the availability to.
What are the implications then for yield and return-seeking behavior? Obviously, rates have already been low, below 2% for a lot of the last year, and we've seen people look for risk because that's where they're getting a return on their investment. Are we going to continue to see that?
Right. It's still a search for yield world, so to speak. It's still somewhat of an equity-biased world with those yields now below inflation again. Now, that's something that wasn't happening a year ago. Real yields were positive, real yields are negative. Yield curve is normalized. Good environment for equities.
I want to just pick up on what you said earlier, that you think that the onus is now on the ECB. I mean, what is the case for the ECB to start tightening a bit after they essentially put that on hold? They did the handoff from Mario Draghi to Christine Lagarde. They haven't indicated that they're going to start tightening. Are you starting to see the numbers point in that direction?
It's more the narrative we saw in Europe coming out of the second half of last year, that maybe negative yields has not worked the way we wanted it to. And that now, what will Christine Lagarde say? Will she have a different view, a different path? That's something that's on our mind. We saw Sweden kind of blink at negative interest rates a month ago or so. Will the ECB come to a path to getting normalized or more positive rates? We think that's something beyond the market's mind.
Yeah, and I think one thing that they've learned is that it's detrimental to the banking system and not healthy for their financial system. So you're probably going to get a handoff to more fiscal policy as opposed to monetary policy. I think most central bankers feel they've sort of reached the limit of what they can do, and they want to stand pat and support the economies, but something different has to take us to a next leg of stimulus where stimulus is needed.
So we're not exactly talking about a move on the interest rate so much as it is support from the fiscal side.
Potentially, at least no more negative on the interest rate. Is there a path to positive on the interest rates? That's what will be on the market's mind as we move further into the year.
But this drop in interest rates, it helped propel markets. The multiples are now, about 19x? But now we have to turn our attention, if you're an investor, as you point out, to real earnings.
Right.
And what do you expect going forward? Because we're not going to get that wind in the back of our sails.
Well, number one, it turned housing second half of last year. Now it's positive for the U.S. economy. So that's good for the economy. Now earnings, so we get a little bit steeper yield curve in the states. That's more supportive of the banks, the financial sector. We don't think it's a headwind for companies borrowing money or individuals borrowing money yet. So it's probably neutral at this time. The area we like about interest rates, short term, the bond market and the Fed are in sync, around 1.5%. They haven't been in sync for years. That's arguably good news.
How long can they stay in sync, just quickly?
For the rest of this year, we suspect Fed stays on hold, inflation stays relatively low.
Let's hope the Fed is listening. John Augustine, CIO of Huntington Private Bank, good to have you here.
Thank you.
John.